Welcome back to the Lance Roberts Show. Today we're visiting with Nomi Prins, of course, the author of Collusion, and her website, nomiprins.com. Nomi, we left off in the last segment. You made this very great statement about what's happening, this rise of populism and national. It's interesting. We have a rise of populism from the citizens. We have a rise of nationalistic leaders from the elected official class. And of course, we had central banks globally doing, scrambling, just injecting massive amounts of liquidity into the financial markets to try to get economic growth going again. And while we've seen some rise in economic growth and prosperity, we saw a massive increase in asset prices, which to many degrees really kind of exacerbated the wealth gap that Ray Dalio was talking about, this wealth inequality, the things that you've been writing about a lot lately on inequality. And of course, a lot of that was fostered by these central bank interventions. And interestingly enough, as soon as we have a small little hiccup in the markets, 2018, the S&P 500 is down 4.4% for the year. And yet the central bank completely reverses course on their tightening of raising interest rates and reducing their balance sheet. They completely reverse course. Now they're patient and considering using quantitative easing as a regular monetary tool. Doesn't that worry you that really the underlying economic viability of the country is really much less than what maybe headlines tell us?
Yeah, that is also a really important set of connections you're making, Lance. And I know you've also published a lot of graphical information supporting this very issue. And I always watch that because it's really important to look at the data. One thing, just in the connection of all the economic situation versus central banks, is some information I like to look at, which is actual GDP growth. Now, there's lots of ways of measuring economic growth, and it's a whole other conversation as to which is the most accurate in terms of capturing sort of the prevalence of most people's feeling about their own personal economic growth and how that relates to the countries. But in the last 10 years, since the financial crisis, if you look at the economic growth of, say, just the United States, what you'll see is that on average, it's been very close to zero, in that there's been some negative years, there's been some, close to 0.1% years, there's been a few years or quarters over 2%, but on average, there's been no sustained growth over 2% at all over the last 10 years. But what there has been is a tremendous growth in, yes, asset prices, but that was fueled by the growth in the Federal Reserve's balance sheet from $800 billion to ultimately $4.5 trillion. Now it's back a bit, just over $4 trillion. And obviously with reduced rates at first to zero and then now very low, to keep the price of money, the cost of money to the financial system very low. And of course, this has been a global phenomenon. So you have asset prices growing, you have the balance sheets of these major central banks growing, and you have economic growth kind of bobbling about, particularly for some of the main G7 countries, around very low. So that goes back to the recipe for people's own economic uncertainty, as well as the gap in income and wealth inequality. Because if you have a lot of money from central banks going into the markets, whether that is through the banking system and then to corporations, and then into their stock buybacks, whether that is into bond prices, whether that is into quantitative easing mechanisms that actually have central banks buying treasuries and mortgages and corporate bonds and even some stocks around the world, it inflates artificially the value of these financial assets. And so for people that own them, that's positive, for people, and it's predominantly wealthier people who are even active in these markets. They see a rise in their wealth because this money is funneling into financial assets, and some people get some benefit from that, of course, that are involved as well. But most people are not, and the economy itself is not, and that's where you get economic disparity and income inequality and this sense of frustration. But central banks, particularly the Fed, watch the markets, even if they talk about the state of the economy as sort of an excuse for what they do and what they're going to do. So what we saw last year, with what you mentioned, the S&P going down by over 4%, and just generally being a lot of tension and volatility in the financial markets, particularly the stock market in the last quarter of 2018, was a real fear that central banks, particularly the Fed and then other ones, because the Fed's the leader of central bank policies around the world. It has been for a long time. It certainly has been acutely since the financial crisis, was going to seriously tighten their books, seriously sell off, or at least let run off and not replace a lot of the bonds that were on their book. What would that do? That would increase the cost of money in the long run. That would increase rates in the long run. And in tandem, they were also raising rates last year 4 times, which was on their forecast. So the market got concerned this was going to keep happening. Jerome Powell, the chairman of the Fed, had until the end of last year indicated this was going to keep happening. And as a result, when the year opened on January 2nd and 3rd, the markets were very, very upset, taking a look at, okay, well, we're going to lose our supply here. As a result, Powell turned around and said, sorry, that's not really what I meant. I'm paraphrasing. But, we'll just keep this whole stimulus, and I mean by that monetary policy stimulus money from the Fed and other central banks going. As a result, other central banks were like, okay, sigh of relief, we'll keep ours going too. And as a result, the markets have been much more happy since that turnaround.
It's interesting you bring this up because, one thing I've written a lot about this is, there were a lot of people out over the last several years. Jeff Kunlak, Bill Gross, others have been out talking about how interest rates were going to go to 4 or 5% in the economy, and that, the bond bull market was over. And I kept repeatedly writing that wasn't going to be the case simply because the U.S. economy in particular, and the rest of the world's the same way, but particularly in the U.S., we're now very heavily leveraged as individuals. Credit card debt. We and you were talking about earlier how many individuals don't actually participate in the financial markets. It's because they can't even come up with $500 for an emergency, much less actually save money. And so when you have small changes to interest rates in an environment that's already heavily leveraged, it immediately causes things to slow down. And certainly we saw the Fed raise interest rates, and immediately the housing market slowed down, auto sales slowed down, credit card delinquency started to rise. So, it's interesting that such small changes now to policy have such a big effect on the economy. And yes, while the Fed may now be patient about raising rates further, the damage is already done because the rates have already risen. And monetary constraint upon the average consumer is already in place. And so the question I have for you is do you think the Fed really takes into account what the real financial structure of the U.S. economy is in their decision making, or is it primarily focused on the asset market?
Well, that's an excellent question. I think their concerns are about the asset market, but they discuss publicly what's happening with their own sort of set of economic indicators. They know, actually, because, for example, the New York Fed, sort of the major Wall Street arm of the Fed, does these quarterly reports on credit. And particularly consumer credit, what they call household credit. And that is, to your point, a massive credit card debt, student loan debt, auto debt, household debt on mortgages and so forth. And so they know, because they report, that the last quarter of their reports for the end of 2018, those figures were all at historical highs. So they know the data behind what you just said, which is that people are effectively maxed out, and yes, also unable to save because they're spending too much already on servicing their own debt. And so, yes, when prices go up in terms of interest rates, the price of money, the cost of that debt goes up, on the margin, they have to pay more. Because what do banks do on the back of that? Banks have been the recipients, and they also run and work with all of the credit card companies. They make the auto loans and mortgages and so forth. They have had the benefit of cheaper money than people anyway. They have the connection to the Fed. So when the Fed made rates zero and kept them low for a long time and even started to raise them a little bit, banks were still receiving their money very cheaply from the Fed and able to keep their costs of operation from that perspective low and also invest that money in the markets and financial assets and so forth. So when rates started to go up, they started to raise, credit card companies, also started to raise the cost of servicing debt to the people that took it out.
Right.
So yes, people are more and more stretched because they couldn't save, and when they did save, they weren't getting a high interest rate on their savings, so they couldn't accumulate money in their savings anyway. And then they take on debt to make ends meet. And then the cost of that debt goes higher even by a little bit. So it's interesting because the Fed knows these numbers. Like it could technically do that math. But the big mistake that the Fed made in the very beginning of how they artificially inflated markets in the banking system 10 years ago, 11 now years ago, was that they did not require some sort of give back from banks or some sort of equity between the money that banks were getting and the low cost versus what they were doing with respect to their own customers. And so as a result, when you go back the other way, when tightening happens, when rates go up, banks still have a bigger benefit and people don't. Again, that goes back to the unrest economically of people.
Right.
What else does the Fed look at, though? It looks at, and this is why I think Powell turned around his statements last year, which were very hawkish going forward at one point, to being more dovish this year. They do look at the markets. Because at the end of the day, and this is actually very interesting. I don't have the graph for this, Lance, but maybe we can get that out. I looked at a report that just came out on bank data. And one of the really interesting things that happened at the end of December 2018 was that banks bought a lot of medium and longer term treasury bonds. Now, technically, this was during the time where the Fed was still saying they were going to tighten their book or basically sell their treasury bonds, meaning that the value should go down and the rates should go up. This was exactly where the Fed was. And at the same exact time, banks were buying those treasuries. That would have been the wrong bet if treasuries were going to continue to be sold. So, and in a larger amount, right? So they had to know that something was turning around. And this goes back to the dialogue that happens on a regular basis between the financial system and its sort of financial support, which is the Fed. And that goes back to the markets because they're saying, look, I'm paraphrasing, but we need money to stay cheap. You know, you got to turn around. Look at our stock going down. Look at our financial asset values going down. And I think as a result, the Fed did turn around. It wasn't simply because economic growth is slowing, though that's what they talk about.
Sure.
It was because there were some real issues with liquidity, with the price of money for the financial system, and the Fed did not want to get caught up in another plummeting of the markets and the financial system.
You know, it's interesting you bring that up because I just wrote an article out today on Monday. Bill Dudley, who was a former Fed president and has been involved with the Fed and the FOMC policy-making committee directly, made a very interesting statement. He says, I'm paraphrasing here. He says, I don't really understand what the whole hubbub is over the balance sheet. You know, the only reason the Fed did what they did is because banks needed more reserves. Well, the only time banks need access to more reserves is potentially when there's an issue with liquidity. And it was interesting because on Christmas, right before Christmas, the Secretary of the Treasury, Steve Mnuchin, comes out and says, hey, I'm going to call all the major banks and assure them that there's absolutely no problem with liquidity. You wouldn't do that unless there was an actual problem with liquidity.
Yeah, and you wouldn't do that unless you knew from some conversation with the Fed that any problem would have a resolution, which turned out to be Powell coming out in the beginning of the year and saying we're kind of reversing our hawkish course right now.
Right.
I mean, these things don't happen in accident. I mean, at the time, and I remember exactly when Treasury Secretary Steve Mnuchin did that, and I thought at the time, well, you're kind of alerting markets to the fact that banks don't have enough liquidity by even saying that you're talking to them about assuring them about liquidity. But now that we look at this a month or so later, no, there was something else going on, which is that was the public statement. But the action that banks took privately and ultimately the action that that Jerome Powell took publicly was to effectively know that there would not be continued tightening in the near term, at least, and that therefore they could relax and buy Treasury bonds. Now, the Treasury Department needs them to buy Treasury bonds because the Treasury Department basically issues that debt for the U.S. government. That debt is at all-time highs. The relationship of debt to GDP in the U.S. and throughout most of the world is at all-time highs, particularly the developed world. And so we have this situation where Mnuchin actually needs banks to have liquidity because part of what they do with that liquidity is help the Treasury Department continue to finance the country with debt. So it's all connected. But the piece that was missing when he did that, and when the markets were wobbling at the end of last year and the very, very beginning of this year, was for Powell to step in and say, all right, I'm not going to dump treasuries into the market. I'm not going to sort of, continue on this tightening. I'm paraphrasing. And ultimately, again, we've seen banks be happier, and we've seen the market rise on that
Right.
sort of reversal.
Well, you talk about debt being at all-time highs here in the U.S., and of course that, the Treasury needs to issue this debt because, we're running $1 trillion deficit in an expansion right now, which, is highly unusual in and of itself. But I bring this up because when we come back from the break, Nomi, I want to talk about why debt doesn't matter. Of course, this is at least one of the conversations that's being had now, is that debts and deficits don't really matter to the economy or to growth or really to pretty much anything because we can just print our own money. We're going to come back and talk with Nomi about that right after the break. Don't go away.
Lance Roberts' blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.